All right, let's just get right to it. It's the one question that's on every crypto investor's mind right now. Just how low is Bitcoin going to go? I mean, the market feels chaotic, uncertain, but what if the past, what if history held a map for the road ahead?
So let's dive in. Obviously, nobody has a crystal ball, but we can do the next best thing, and that's dig into the historical data. Looking at past cycles, based on our source material, we're going to see if there's a hidden pattern, a rhythm to these brutal bear markets that could maybe help us make sense of what's happening right now.
So how do we even start to figure this out? Well, analysts, they look way beyond just the daily price swings. They've got a specific toolkit of indicators. For this explainer, we're going to focus on a couple of really key lines that have historically defined Bitcoin's market structure. Let's start with two of the most important ones.
First up, we've got something called the realized price. Now, the concept here is actually pretty simple, but it's super powerful. Imagine you could find out the exact price that every single Bitcoin was bought at, and then you average all those prices together. That number, that is the realized price. It's basically the market's collective break-even point.
Then, below that, we have the balance price. This one is calculated from the realized price, but think of it as a deeper, more fundamental floor. In the absolute darkest days of past bear markets, this is the line that has historically marked the point of maximum financial pain. And this is where it gets really interesting. When a bear market really takes hold, the price doesn't just fall randomly. It often gets pulled down towards these two levels, almost like they have their own gravitational field. The realized price, that's kind of like the first stop, but the balance price, that has historically been the final destination.
Okay, so we've got our tools. Now for the fun part. Let's actually apply them to Bitcoin's entire history and see what the data tells us. You might be surprised at just how clear the picture really is.
And what we find is, well, it's a shockingly consistent pattern. Just look at this. In 2011, the bottom comes after the price falls below the balance price. Okay, fast forward to 2015. Yep, same thing. 2018, there it is again. And even in the last major cycle bottom in 2022, the exact same thing happened. It's a clear, repeatable pattern.
I mean, the analyst from our source material really puts it bluntly here. Before any real, lasting, long-term bull market has ever kicked off, Bitcoin has first had to make this painful journey below the balance price. It's been a prerequisite every single time.
But you always have to ask that question, right? What if this time is different? And the big counter-argument here revolves around this idea that the last market peak, well, it wasn't a classic bubble. It was something else entirely, an apathy top.
So what's the difference? A euphoria top is exactly what you'd picture when you think of a bubble, right? Media frenzy. Your uncle is asking you about crypto at Thanksgiving. An apathy top is the total opposite. The market peaks not with a bang, but with a whimper, because general interest is low and people just kind of stop caring.
And that brings us to the million-dollar question, doesn't it? If the top was less extreme, if it was more apathetic, does that mean the bottom gets to be less painful too? Does an apathy top mean we get to skip that final brutal drop below the balance price?
Well, guess what? The data actually has an answer for that. The last time we saw one of these apathy tops was back in 2019. And yeah, the conditions were different, but the ultimate outcome was not. During the crash that followed, the price still found its way below the balance price. The pattern held.
So, if we take this incredibly consistent historical pattern as our guide, what does it suggest about where we are right now? Let's bring this whole analysis into the present day.
Okay, so right now, according to the analysis, the realized price, remember, that's the market's break-even point, is hovering somewhere around $55,000. This would be that first major historical support zone based on the pattern.
And that deeper historical floor, the balance price, is currently sitting at around $40,000. Now, it is absolutely vital to remember that these levels are dynamic. They're always moving. They're not static targets. But based on every single previous cycle, this is the zone where bear markets have historically, finally, ended.
The data tells us what has happened, but it doesn't really explain the why. Why do we keep seeing these repeating cycles of euphoria and then despair? Well, the answer has a lot less to do with charts and a whole lot more to do with plain old human psychology. It's really just a predictable emotional roller coaster that drives these things. At the start of a downturn, you get denial. As prices fall down towards that realized price, denial turns into bargaining. But that final drop, the one that goes below the balance price, that's usually driven by total capitulation, the moment everyone just gives up. And ironically, that moment of maximum pessimism has historically been the point of maximum opportunity. You know, there's this fantastic quote from the source analysis that just hits the nail on the head. Bear markets make fools of both bulls and bears. Bulls look foolish for not selling earlier, sure, but bears often get totally wiped out by these vicious relief rallies before the downtrend starts up again. It's an environment that's basically designed to confuse everybody.
So we're left with a clear, if maybe uncomfortable, historical pattern. It's a path that's been carved out by both cold hard data and raw human emotion, and it has repeated itself time and time again. We've seen the map laid out by history. I guess the only question that really matters now is, will a market follow it one more time?